U.S. equity market leadership has shifted in 2026, a shift that actually started in November last year and has continued early this year. Several S&P 500 sectors that lagged in recent years have posted strong returns through late February, led by sector gains in energy, materials, consumer staples, and industrials. While each of these sectors has posted double-digit percentage gains year to date, the overall S&P 500 index is relatively flat, primarily because the index's largest sector, technology, which still contributes 1/3 of the total value of the index, is down more than 2% this year through late February and down nearly 7% over nearly 4 months since the end of October. Technology spending is growing, and technology earnings last year and in the fourth quarter led the market. But many of the stocks in the sector have traded lower. Why? We attribute it to AI angst. By now, it's hard to miss the rapid technological advancement and build-out of generative artificial intelligence, or Gen AI, over the past 3 to 4 years. One way to look at the growth is the capital spending commitments from the largest cloud computing hyperscalers, and this includes most of the Magnificent Seven largest companies as they build data centers and compute capability to drive the large language models that include OpenAI, Anthropic, Gemini, Llama, Grok, and others. According to S&P Global, capital spending from the largest hyperscalers will exceed $650 billion in 2026, up from just $150 billion in 2022. The growth in hyperscaler capital spending has become a key component of U.S. economic growth, as measured by gross domestic product, or GDP. While U.S. GDP is still led by consumer spending, the technology-related components of business investment in 2025 contributed 70 basis points to U.S. GDP growth of 2.2%, compared to just 25 basis points contribution in 2023, 2 years earlier. At the same time, for the 3 years 2023 through 2025, the S&P 500 technology earnings increased about 62%, but the stock price of the sector on a weighted average increased 160%. So spending has surged, earnings has surged, and valuations have surged. And this creates high expectations and potential for disappointments and pullback. Although the technology sector has sustained strong gains, it's not been perfectly linear. Early last year, the demand for AI compute power was questioned as a few lower power AI models in China gained notoriety. Then late last year, we heard concerns about an AI bubble as capital spending projects began to use more debt than prior deals receiving cash from equity raises. And these scares abated somewhat as the technology moved forward when AI models were trained and shifted to inference, requiring even more computing power. The 2026 weakness is attributed to agentic AI, or as AI agents or chatbots are being used to optimize very specific tasks and could threaten companies that provide subscription services and software to large businesses or enterprise customers. Most of the technology sector weakness in 2026 has been in the software subgroup and is the latest concern. It looks like AI spending levels will remain elevated in 2026 and will again contribute to U.S. GDP growth. Companies that provide the compute power and participate in the data center and infrastructure build-out should do well, but there will be some disruption as the software weakness suggests. We expect winners and losers as agentic AI grows, which for investors requires close attention. AI as a transformative technology has spurred and will spur exciting innovation. In portfolios, we still like technology exposure, but the sector could remain increasingly volatile. We believe that recent rotation in sector leadership can continue, favoring broad diversification and frequent rebalancing to manage exposure. We remain constructive on the U.S. equity market overall, but with volatility, and we believe investors should scale back return expectations from the annual double-digit percentage returns of the S&P 500 over the past 3 years. For specific recommendations and strategies, please contact your D.A. Davidson financial professional.